revenue is where you're going to either live or die. It's affecting things so much more dramatically than people even give it credit for.
Even though the market is hard today and it looks bad, if you're going out and buying today, it is the best time to be buying from purely an understanding of the market standpoint.
At what point will this not be reality anymore?
Will the market return to what it was 3-4 years ago at all? Welcome everybody to Self-Storage Income, and today I'm lucky to have back with me my partner and friend Jonah. How you doing, man?
Doing excellent. Thanks for having me. I appreciate it.
Appreciate you being here. So we are talking about deal analysis, and this is a big topic, obviously. But what we really want to break down here is, I think, some of the fundamentals, but also how things have changed. Because over the last 5 years, I have seen the biggest change that I've ever seen in deal analysis. I mean, it's not even close to the change that we saw 2006 to 2010. There wasn't that much of a change, right? But 2018, 19, 20 to today, wildly different. And so I want to look at, in today's opportunities particularly, how are we analyzing these deals and what are we looking for? So right off the bat, let's look at, what are some of the big changes that you've seen in how you are looking and underwriting deals?
Yeah, absolutely. I wasn't even underwriting deals in 06 to 10.
Yeah.
So I don't have that context.
But 19.
But I started at about 17, 18
Yes.
and have been underwriting since.
So you saw
obviously.
that change in 19 to 21.
Oh yeah, obviously. Thankfully, we were already being really conservative with the underwriting.
Yes.
And so, as things get worse or things get better or whatever, as long as you're underwriting things conservatively, you're kind of golden. You're fine.
Yeah.
A lot of people didn't. A lot of people changed their underwriting method with the times, but those times were, as we both know, not
real.
sustainable, not real.
Not at all. Yeah.
And so now people are hurting, unfortunately.
Yes.
Yeah, but a lot of things changed. Everything from your bottom line project level metrics that you're comfortable with based on rates and cap rates and interest rates to how aggressive you are with rent increases and in-place rent changes and all sorts of things. So things have definitely changed, but at the same time, the fundamentals are the same. Is the project good? We can talk about how much debt costs and how much equity costs and how much that market can handle rent increases, and that will all be variables you want to take into consideration. But bottom line, are you buying it right? And, is it going to be sellable as a one-off asset, or are you planning to hold it and put it as part of a portfolio sale? You kind of have to know those things going in to properly give it an exit cap rate that is realistic and achievable and all that kind of stuff. So I don't know if that really answered the question, but
it does.
We definitely have modified some pieces of it. But for me, it's always been the fundamentals, and the fundamentals haven't actually changed all that much.
Yeah, the fundamentals never do, or shouldn't ever.
Well, for other people, they did. That's the point. Like they changed their spreadsheets and they changed their assumptions based on this new, what they thought was reality, and it wasn't. And so a lot of people are hurting.
Yeah. The big thing that especially that we saw on the development side was this idea of that exit. It's hard, when you think, especially doing the math, to equate a 4 cap at CO versus a 7 cap at stabilized. Those worlds are not, to say they're not even close is an understatement.
Of course.
It is the difference of twice the amount of the asset, right? It's so wildly different. And there's external and internal changes, right? We have those like external changes that you're dealing with, like interest rates and the market of buyers and sellers. In 08, we saw two things. Occupancy got slammed in 08, right? Like it was really hurt. And the market for buyers and sellers gone, evaporated, but so then too did the financing. So 08 was hit on all fronts in severe, severe ways. But what wasn't actually really hit was rates. Surprisingly, we only had a drop of like 7 to maybe 10%. And that was kind of nationwide. Whereas this time, I feel like we saw a lot more rate than we did an effect on, think we can see the numbers on occupancy. Whereas today rates shifted, but occupancy stayed relatively high. In 2008, we got down to like 70%, but rates didn't drop like rocks. That never really happened.
Right.
Whereas today we maintain high occupancy, but rates changed, well, in some markets dramatically.
Yeah,
right?
it's market by market. I've
Yes.
seen occupancy dropped a little bit. Obviously, nothing hit the 70s.
No.
Or
Yes.
no
No,
one's no one should be in the 70s right now, I don't think. I've not seen any that are that low. But I have seen, like, if you look at trends month by month, last couple of years, we're down. I say the market as a whole is down a little bit, I think.
Yeah.
People manipulate that with these new ways of doing revenue management today that
Yes.
we weren't doing
before.
back then.
Yeah.
And so you can manipulate your physical occupancy a little bit that way. But yeah, you're right. Rates, I think on average from what I'm seeing, they've dropped by 15%.
Yeah.
13 to 15%.
Yeah.
It depends on the market, but consistently markets I've seen
Yes.
where the rates are 15% lower today than they were about a year ago, maybe a little bit more, 18 months ago.
Yeah.
And that's obviously hurting a lot of people.
Yes. That's where we've been hit by far the most, because we had some markets where rates went up. They didn't go down. They actually went up. But then we had other ones where rates may have gone down, let's say 15% on average, but you had certain types of units that got slaughtered. And that's where we have one facility that is all big units, right? Buying the facility, the rates when we bought it were at the facility $150, $200 for these huge RV indoor rooms. It didn't have any other units. That's it, right? And the market rate at the time was $600 going for those units. Then today, they're less than when we bought it for on the market, not for our units. Yeah. And so you get disproportionate effects due to not only the location, but then the makeup. We have another asset that's in the same, we have two more that's in the same city. They did not see anything severe like that, right? Yeah. And that was largely due to the larger big units that people were using to move and buy RVs at really low interest rates got hammered, killed. So the discrepancy this time that I can see, especially compared to 2008, much wider, much bigger, due to the rate factor. Whereas in 2008, it may have been an occupancy. You're at 75 versus 83% occupancy. But that's not nearly as a big a deal on revenue as if you're talking about you have a market where rates drop by 30% and one that dropped by 5%, right? Much bigger difference. And then the outcome on top of that, right, with occupancy. So it's been interesting this time around to see how it doesn't seem to be as universal.
Yeah. And so I think one thing I've noticed is the rates, the markets that had the biggest rate drops were competitive REIT driven markets because they were dropping rates significantly because they knew they could make up for it with revenue management. That wasn't the case back then. Nobody was doing it that way.
Nobody was doing it that way.
And so I consistently see that the markets that had the biggest dip are those markets where there's at least a sophisticated operator controlling the market, if not a REIT.
And that was our two markets that got hit the worst. We had Oklahoma City, which we got killed in, and Tulsa, but especially one area of Tulsa. And that was due to, we had a public storage and an extra space open up. And so like you can see the shift. Whereas if you went to our other facilities in Coeur d'Alene, Idaho, no, like we didn't get hit with occupancy or rent drops.
Right.
The only ones that were doing it were us. Right. So to that point. So it's not only to where there's REITs, because we have other areas where we had REITs in, but we didn't see that effect because the market was tight. So the REITs, they didn't have occupancy to fill up. Yeah. So they still dropped rates way more than we'd ever seen in the past, but nothing like we saw in Tulsa. We had one that was a public storage, and their 10 by 10 went from $200 to $60 in 5 months because they had to fill up, right? And so they were filling up. And then we had 3 other markets where rates on whole went up. They actually rose. So this is a big part, I think, when underwriting deals and looking at the landscape is that competitive nature, not just by what's out there, but also who's driving it.
Right. Absolutely.
It just didn't matter.
And I do think, like, we talk about this in-place rate change all the time, but it's affecting positively and negatively, but it's it's affecting things so much more dramatically than people
So
even
much
give it
more.
credit for.
Yeah.
I mean, it's a major driver of the rates going up
Yeah.
and down because people know they can manipulate them so quickly.
Yes.
Like credit to Jesse here, right? I see plenty of markets where the market rate is X and our in-place rate is up here,
Yes.
right?
Yes.
And that's because he was successfully implementing, in-place rate changes.
Yeah.
And it's incredible actually when you see some of the
spreads.
spreads. You're
Yes.
like, dang, that's
Wow, that's good.
Like, let's keep that up. But then the question becomes, can we keep it up?
Can
At
you?
what
Yes.
point will this not be reality anymore?
And two, will the market return to what it was 3-4 years ago at all?
Yeah, because that in-place rate change rate that we got to, is actually where the market was. It's not actually all that impressive when you think about it. It's just impressive because the market rates are
And
down
in some
here now.
cases, it's still below what it was.
In some cases,
because
yeah.
we have like a couple of facilities that haven't returned to it. Where then in other cases, when you do that revenue management, wow, you can really push those rates. And that's why people do it. We have some locations where you go through that revenue management and the market's tight anyways, and you can really drive revenue through it. So it works in your favor, you're right, but it also can work on the opposite side because that acceleration of the revenue also works on the deceleration of that revenue. So when you're looking at a market, what are the things that you would look at to say, if I'm trying to avoid that, what should they be looking for?
Keeping in line with rates here, I think people can make their biggest mistakes underwriting their rates. Expenses are expenses, and you can operate a facility at 45% or operate at 35%. There's a range there, but you're talking about moving the needle from here to here, right?
The revenue is what matters.
Revenue is where you're going to either live or die. Yeah. And a lot of people are assuming the rates will continue to go up all the time, which they probably will from an inflation standpoint, but they are projecting bumps that are probably not going to happen. And it's a little nerve-wracking. I mean, we're going in, we're trying to do our best to figure out what the actual in-place rate is. Sometimes you get lucky and you can see there's a facility for sale and you can actually get their in-place rates.
Yeah.
But for the most part, we're taking historical data and we're looking at all those many months, trailing 24, trailing 36. What were the averages over those periods of time? Because we know they're low right now.
Yeah.
Right. Where do we feel they can bounce back at a market level?
Yes.
And then where can we take them based on our revenue management plan? And you really have to be careful because you can really mess up the projections of a deal and screw yourself. If you project too high or you say you'll get there way too fast.
Yes.
And we've seen a lot of people do that. And that's why a lot of these deals are on the market right now.
And two, one of the big reasons is also along with that, because when you're looking at the overall, so when you look back and you see the overall trailing, 12 of rates or whatnot, if you went back just 2 years ago, you didn't see a discrepancy nearly as big. Whereas today, when you're looking at those rates, so if you go and use Radius Plus or whoever it may be, the differential in those rates between the busy and slow season today is massive.
It's true.
We went through 3 years. There was not even a seasonality behind it. We had 2 years where in most markets, rates not only didn't budge, they went up. And that was historically not normal, right? Historically normal, you have a slow season.
Oh, yeah.
People go back to school, the housing market slows down, you have a slow season. Then you have a busy season and you can up rates because there's more demand. But today, the difference of slow season to the busy season, I've never seen spreads like that ever. So when you're calculating it, if you're calculating it in June and not in February, your results will be staggeringly different.
Both in the rate you expect to collect and the lease up velocity that you're projecting too.
Yep.
A lot of people they want to buy a flip that, they need to raise the occupancy 20%, 30%, do a little bit to the expense bottom line, and then flip the thing. If you buy that thing in December, and it's very different than buying it in April, depending on your timeline and what you projected. I mean, people project these tight timelines. I've seen some really quick turnarounds that they're expecting. And you really need to give yourself an extra year, an extra busy season at least, to achieve what you're putting in those projections. It's interesting to see how the data out there is just okay. Like there's a lot of it. Don't get me wrong.
But
you've got Radius, you've got StoreTrack, you've got Tract IQ, you've got Yardi, you've got all these sources. But at the end of the day, these markets are volatile. And if they're not actually scraping those rates every day at every facility in the little trade area you're talking about, you're better off just scraping it yourself and getting a triple checking that every single unit.
Because we've looked at this and we've seen this where you're on those platforms and then you go to the website
and it's different.
It's different. When we were underwriting, this was a big thing when we were underwriting the Surprise project, when we're like, okay, well, it's saying here, then you went on, but they're offering it here, sometimes lower, sometimes higher. And then you go the next day, because the dynamic pricing nature, especially out of these REITs, what happens is we have, 3 people move out, or the day before we had 2 people move in. That changed our own supply dynamics of the units. So then that rate, boom, boom, it automatically changes.
And we do the same thing.
We do the same thing.
All of our software does the same thing. It's dynamic based on your own occupancy, based on the rates that you feed it from your competitors. All that is dynamically changing your prices. And then, of course, you've got value pricing too, to consider. And that's making all of this a lot more challenging to underwrite.
Yeah. And that didn't happen at all prior. Prior, it was because there was no reason to. You're at 96% occupancy. So what everybody did was just move rates up as high as it can go.
Yeah.
And nobody, though, was discounting to move people in. You would discount to street, like whatever the price in the market was, right? But then outside that, even individual rates didn't matter much. It was just lift them all up, right? And we actually went through a period of time that was probably 2016, 17 on where that happened. We're talking like 8 years of rates and occupancy that just went straight up. And that changes wildly how you look at your dynamic pricing and revenue management, where all of a sudden it became standard, just everybody's, 9 to 15% total facility, raise your rate, right? That doesn't exist anymore. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
Well, I don't know if it ever actually existed. People got lucky because it averaged out a little bit better than it does today. But today you could have your 5x5s could get killed.
Absolutely.
Individually. It's amazing to see things like that.
Yeah.
Or they could be the ones that soar. They rocket up because no one else built a lot. A lot of times these small units are rocketing up right now. I've noticed that people are getting some ridiculous rates.
Yes.
For 5x5s, for lockers, for 5x10s.
And then the big units.
But the big units are sucking a lot of the cash flow. Like they're losing it all through the big units.
And that was a big change from 4 years ago, because it was the opposite. Those big units, like our one facility, you're getting $600-800 in that market. $600-800 for those big units.
Well, they used to talk about that J curve, right? Like you used to hear that term, right? Where your big units would go back up at it as a price per foot.
Yes.
And I'm not really seeing that anymore. It's straight linear down.
Yep.
And very rarely does it have any kind of lift back up. Now it does in some markets where there's just not enough supply of the big units, but that's fewer and further between at this point. Yeah. It's pretty much a linear drop from your smallest units being your best price per foot down to your biggest units being the smallest.
Do you think that's going to change with interest rates as interest rates start to come down and people start to move again? Because one of the large primary reasons for big units was moving. You got a big house, you got, and big toys, which you could finance cheaper, which you can't do today, so nobody buys them. But you have a 2,500 square foot home, 3 bedrooms, right? And you're moving, a 10 by 10 doesn't do it. Right? No, not even close.
I don't even know what size unit I'm in right now. Because I moved up here, right? Yeah. So I moved a 4-bedroom house and ended up in like a 12 by 36 or some massive unit. Yeah. Like it's a crazy size unit, and I still barely got everything in. Now I could have stacked, I guess, but people will crush their own stuff if they do that. So those big units do obviously require major moves. People, and sometimes they're contractors or whatever, but I think you're right. Maybe interest rates coming down will affect big toys and moving, and therefore bring some demand back to those larger units.
You want to know what's interesting? I hope so. We need it. You want to know what's interesting? After 2008 was the opposite. We would buy facilities and the small units were empty.
Interesting.
And the big units were all taken. So like we bought Middleton Road and we had to convert half the facility because they built like 5 buildings of 5x5s and they could only fill up like 10% or 20%, right? So we had to convert them all to much bigger units and those filled up to 10x20s like that.
Yeah.
And the reason being was in 2008, people were moving. They lost their homes. They were downsizing, right? And then the people that weren't were all crushed. They didn't have jobs. They didn't things like that. Yeah. So small units to put luxury things in, skis, stuff like that, just an extra closet space. People were like, I can do without that.
Yeah.
But the big units, I have to have it to move.
That's fascinating. And if you think about what COVID did to a lot of people, not everyone, but a lot of people needed to move into their home for an office. So all they needed to clear out was a closet or one bedroom. And so you saw the demand in those smaller units, right?
They were utilizing the space they had better.
Exactly. So that's interesting how different phenomena can affect which units.
And I think that's still
demand across
the same today when you're talking about COVID. Like people are utilizing space differently because they can't afford. So I need smaller units because I'm not changing the whole house.
Right.
I'm just changing something. I'm not moving. And I want to buy something, but I'm also not, I'm postponing upgrading my home. So I'm not moving anymore. So I'm going to keep my life upgrading, but I'm going to get a smaller unit. Whereas then the big units just get killed.
Yeah. Yeah.
And these change. These cycles always change.
Of course.
And it's interesting as you see, especially the big volatile ones. One of the main reasons they change as those unit types get slaughtered, people stop building them. And we saw this in Arizona. We redid our unit mix, right? Now, we cut down on the big units, which actually I still think I didn't want to. The reason I didn't want to was because of very specific demand in that location for a very specific product type. There's 2 RV dealerships being built on our side, right? And it's the highest RV sales rate in the whole entire place. And so we had something like 60 of them. I wanted more.
High 50s.
Yeah, high 50s, low 60s. I wanted more, but the banks would not allow us to do it because they saw that and they're looking everywhere and they say these rates are, it's like, we don't care. And you may be right, but it doesn't work today, so we're not going to allow it. So even though I really wanted to, and I still do believe the demand is not only there, it didn't matter. And so this happens a lot because then what market participants look at is they look at rate change, overall market rate, rent per square foot, and they say this size has gotten hit too much. So then the banks and other people start to constrain that type of product from hitting the market. And what actually happens is they oversaturate the other types because they just make up. So you're going, all right, you have 50, 20 by 40s. You're now going to turn those all into 5x5s and 10x10s. Well, you just added so much square footage of that type to the market, right? So even if there was a short-term demand, you're actually oversupplying your individual market. You have 2 or 3 facilities built and they shift to 20% of their individual space down to units that are at the moment in higher demand. Then the moment that flips, they're caught off guard.
Right.
Because then all of a sudden it flips and it goes the other way, but the market's just been oversupplied. And this is the common problem we see with development is the tail wags the dog, where it's that quick market reactions. And this is a problem that I think everybody has in real estate too, whereas short-term things end up dictating the whole narrative. And that kills people. It killed them during 2008 in a big way, like really big way, where if they would have kept it or they would have adjusted or they would have done something, the market changes and rebounds. But during the time, it didn't seem like it, right? We were at 75% occupancy. Everybody was like, just get rid of these, sell them off. It's never going to change. This is over. It's dead. So we were buying things at 75% occupancy at 20 cents a square foot. I thought we were stupid because there was no signs of anything changing. In fact, it was the opposite. Everybody's like, it may be a decade, right? And yet that's not at all what happened. In fact, it was the other way around because the government and society's actions, when it's big one way, it goes big the other way and it reverts back. And so what we saw was that demand came back so strong that it blew away any kind of concept that we even had of attainable rates or square footage, or we didn't think we would see 90% ever. And all of a sudden within
or 95
or
or
95 or
97.
96.
Yeah, it was
and
crazy.
the idea of a $2 rate, that was unimaginable 10 years ago. Like in the markets where I was at, we were buying at 50 cents a square foot a month. And within 4 years, we were at $2 a square foot a month. When we bought it though, it was unimaginable that we could even get there. We were shooting for 80 cents, right? Like it was like, oh, that would be amazing. And so I see too, one of the problems we have with underwriting is lots of times the tail wags the dog. And this happens on both sides, good and bad, right? Because this happens to you in good times. It happened to us in good times because you only know what you know. If I'm looking at an asset and I say, all right, the market's at $2 a square foot and this facility is at $1.50, I have a 50% spread. Market changes, now it's at $1, it's 50% negative, right? Also the opposite way in good times. It's $1 and you're buying it, but you've only seen rates go from $1.50 to $1. And so you're like, oh, if we could get to $1.20, then all of a sudden it ends up being at $1.50 or $2. And so when you're talking about the fundamentals, I can't stress that enough because that really is what ends up making it work in the long term.
Yeah, and on unit mix, I think it's interesting because you have to remember most of the people in the industry don't really think about the stuff we're talking about.
No, they don't.
Especially the fee development builders. Like they're out there building these massive multi-story facilities, and unless they're truly consulting with somebody like you or I, or somebody that's designed unit mixes and watched the market, they're just building what fits. Like
they go to an architect and they go to a builder and they say, I have this much space. How should I split up the
And they're
units?
Great architects. Don't get me wrong.
They're great. Everything
but
else.
Most of them haven't built a lot of storage.
And two, even if they haven't operated them. Wildly different. So what they do is they optimize space. Instead of looking at what the market does, they say, we have this much space. How can we optimize it? And then we just want a general, like, I can't tell you how many facilities you go see and you're like, all right, if there's 10 units, right, they're pretty much divided. You have the bell curve where little on that one end, little on the other, but then the middle's all divided up basically equal.
Yeah.
And you look at it and you go, the market couldn't have been like that when you started building it. As in there couldn't have been an equal distribution of demand across 5 units. That didn't exist. So why did you build it like that? And the point is that's how the architect and builder, because they're doing what they should be doing, by the way. That's actually what they should be doing. How do you optimize space? How do you utilize the space? But product selection based upon current, past, and future demand, right? Obviously, they don't look at that because that's not what they do. And when you're a developer and you're going to flip it, you don't care about operating it.
Because you're not going to lease it up.
Because you're not going to lease it up or anything. So
yeah, and then there's also, a lot of people don't have to think about this very much because they're buying what they're buying. You buy a facility that's built in the 90s, you can do a little bit to manipulate it, but probably your budget is not going to allow you to completely manipulate the unit mix of an existing facility. So really, for people who are trying to learn, it's a good project to go underwrite a conversion or underwrite a new build so you can actually see what these unit mixes should look like and understand it and like design it yourself and then get someone else to double check your work. Because at the end of the day, we're building for what the demand is and what we believe it will be, and not just some random Tetris mix of units.
Exactly.
Right? And there's a lot of work goes into the market demand analysis so that you can figure out what units you should build and what you should price them at. And I think a lot of people take that completely for granted.
I mean, we redid Arizona. I don't even know how many times we redid that unit mix over and over and over again. And I say this because the project, because of interest rates, everything else, we got delayed a year.
A lot happened.
A lot happened in that year. And, when you look at it, if you're looking at just a pure real estate standpoint, that's devastating. But for me, I'm like, that was the greatest gift we could have ever been given. Why? Because we completely redid our unit mix to adjust for what was actually happening. Because at the time, even when we bought the land, everything was 96% occupied.
Yeah,
you
we didn't know.
No idea. You have no idea what real demand is. You have no idea where real prices are. And so all of a sudden, when that year financing just got crushed, we had to get banks and we delayed it a year. By the end of that year, we're like, it's a totally different landscape. So we actually got to change our building project, which we optimized it better for. We cut down on one of the stories. We took it off because the cost associated with going up versus what we could get. And the biggest thing that we said, which I talked about this a long time, but when it was 96%, you could never see it, was that the outdoor drive-up units were going for more than the indoor climate controlled. Previously to that, nobody would have ever thought that would happen because it costs more to build it and maintain it, right? But once that demand that was just over the top went away, so everything was full, you could actually see what people wanted in that market. And it was inverse of what everybody thought.
Yeah.
It was huge. We actually got our rent per square foot to go up, even when you looked at rents going down, because what we did is we changed the unit mix. We did go to smaller units, right? We did change the cost structure per unit because we did more outdoor than climate controlled. The point being is, if we would have been if we would have built it the year prior, the damage that would have done on our P&L.
Missing data. You just didn't have the data points.
We didn't have it.
Yeah, we might call it like some sort of gap analysis, right?
Yeah.
There were no gaps. Everyone was full. Everyone was 100% full in every unit type.
And everybody that was buying facilities in 2019 to 22 was right when the rates went up and everything. We all felt this. I mean, you were going in and looking at a facility, it was 100% full. I mean, outside transitionary units. So I take, if there's a 5% vacancy, but that 5% is filled up within a week, that's not vacancy to me. That's transition. So effectively everything was 100% full. So we're out looking at units and the market rates were going so high because everybody was 100% full. So they're like, you've got to pay 3 times to take up my last spot. You couldn't. There's no way you could actually properly analyze. And when we looked at that and talking with people and seeing that once all of a sudden those markets changed, then you could, right? But
correct.
You didn't know what you had. Like you knew what you had, but it was predicated on the circumstances going forward, which circumstances never do. So what happened was it covered up. In a bull market, it always covers up the negatives. Always, right? It was no different at the top of that market, covered it up. Well, just like in 2008, all the flaws of the housing market were covered up because nobody cared because prices were going up and there was so much demand. That's the thing that people think, which always drove me nuts because going through that, the people that didn't buy or didn't do it, they look back and it's so easy to look back at those people that bought homes and be like, you should have known. How? Like, how would they ever know? They were making so much money and that money was real, everybody. It wasn't fake. They actually made it, right? And so I didn't get caught up in that because I didn't really understand. But the people that do, I don't look back and think, oh, well, they were idiots or anything. They weren't. And so but that's the point. Today, you get to see it. That's why it's so beneficial buying today. That's why it's so exciting to buy today. We don't have those mistakes, or not even mistakes, those markets inefficiencies where we don't have gaps, right? Today, you get to see it. So when we're looking at a facility in a market today, we really can see we can push a 10 by 20 or a 5 by 5. We can't push a 10 by 10. Like we can analyze that, right?
Right.
So it's way easier today to see what's actually there and to start to build plans around it than 3 years ago. And a lot of times we wish, I wish I could go back to when times were high, or, that was the good times. And we got to reverse that. That wasn't the good times. That was actually the really, really bad times. Even though the market is hard today and it looks bad, if you're going out and buying today, it is the best time to be buying from purely an understanding of the market standpoint, I think. Right now, financing for real estate is really hard, even for self-storage. The markets are very challenging. Live Oak Bank is a specialist in financing for self-storage, including SBA loans. They are one of the leaders in financing all sorts of deals and deal size. We trust Live Oak Bank for their specialty in self-storage, their unique approach, and how they help their customers go through the process so there's no surprises. That in itself is a testament to their exceptional service and support. So whether you're looking to acquire, build, or expand a storage facility, Live Oak Bank has to be number one on your list to call. Click the link below right now so you can experience the difference that a dedicated self-storage partner can really make.
There were positives. Don't get me wrong. There were positives. Like that season pushed people to be more innovative, right?
Oh, yeah.
Obviously, COVID itself created innovations because people had to do contactless rentals the next day, right? Which we like to call touchless rentals, but whatever. You had to figure that out or you were going out of business.
Yep.
Because that, people wearing masks and they weren't renting units unless they didn't have to touch you. And so just suddenly, like overnight, it pushed innovation. It added all this tech. Like we were just at the trade show last week in Texas, and it's just mind blowing how much new tech is there and how far along some of these software vendors and hardware vendors have come in just the last few years. So that's all great. That's cool. But what happened after and when the rates started going up and the market rates started going down is now we have to figure out who's a good operator.
Yeah.
Because now it's a different set
Totally
of skills,
different.
right? Before it was how do we move the needle a little bit with our expense load with tech and things like that. Now it's like, can you do the fundamentals? And if you can't, like
and you got to move the needle big.
You do. Because right now your cash flow is sometimes negative on some of these
absolutely.
deals.
We have multiple deals that are cash flow are negative because the rate change and everything else. So now it's like, we got to get in and you got to figure it out. You're like, because at the end of the day, it's net income. That's
NOI is all that actually matters. I mean, everything else, your loan leverage and your rate, all those things matter. Don't get me wrong.
Because
if you're trying to flip a site from this to this, you're talking about NOI. Cash flow is important, but you can manipulate cash flow with the cost of capital.
Yep.
If you paid all cash, you're going to have a very different cash flow.
Yep.
Right. But your NOI is what matters because that's the value of the property. And so if you can manipulate NOI, that's where your money is.
Yeah.
Your cash flow, it's important, obviously.
Yeah.
But you can change that with a stroke of a pen with a new loan, right? I mean, things can change.
Yes. And they will.
And they will.
Yeah.
They will.
Yeah.
And sometimes it's just writing it out until the right time.
We literally could be next fall. We could have rates down at 3-4%. We have no clue. They could also be at 9%. We have no clue, right? But they will change. But the fundamentals that you're talking about and how you be a good operator and what you do in it, that's different than what we're talking about here. Market versus being an operator. And after 2012, 13, the things that we tried, we bought trucks, we were doing all this stuff because it was like NOI, right? And a lot of that stuff actually ended up being really successful that we were doing and trying things that just people hadn't tried before because it was like literally like, okay, well, what can we do with this space? We need to make more income. How can we get it? We're returning to those days.
Yeah.
Where that's what you're looking at. And the market will be the market, but it's like, all right, what do we do here? Yeah. How do we get this net income up? Like our facility with big units. We can't control those market rates. All right, well, now maybe we have to be way more in depth by looking at who is using them and how are they using them. And maybe we change our tactics completely to go, let's go get, businesses to fill up 10% of the vacancy that we have. And how can we target them? And then what services can we add to those businesses?
Ancillary income sources, all sorts of things.
Yeah. That all comes out on the table today in today's market. And I think this is even more important because this summer was the first time we saw really rates and occupancy stabilize. 2 years of the opposite. Whereas this summer, finally, we saw rates that they actually lifted and we saw the baseline through the winter, right, and fall. And so now it's like, all right, we know what we're playing with. Whereas over the last 2 years, it was always a question, will occupancy keep going down? Will rates next slow season be lower than they were the previous because they had been? Whereas the last slow season we just went through, we saw that stabilization. So it is a change in mentality, right? And how you're looking at deals and what you're doing. And when you're analyzing those deals, when you're looking at the fundamentals, then what are the big things in today's market that you're looking at? Let's say you got a 50,000 square foot facility. It's in a medium market, 100,000 people. It's not huge, but it's also not a rural market. What are your key indicators on those fundamentals that you're looking for?
The first thing I want to look at is where it's at today. Is it stabilized? Is it in lease up? And do I feel confident we can lease it up? And so a lot of these deals are in lease up. And I think the reason for that is a lot of developers built them. They didn't necessarily intend on operating them, but they kind of got stuck operating them because interest rates rose and nobody was willing to pay what they thought they were going to get on the exit. And so I feel like there's a lot of people that were forced into being an operator that maybe didn't even want to be an operator or have no business being an operator. But that's interesting because now we're looking at deals. Like I looked at one yesterday that had legitimately maybe 60% vacancy, something like that. It's in lease up, but so are 5 of the other competitors in the immediate trade area.
Yes.
And so you really got to do a lot of work on your demand analysis and your market study piece because you got to feel pretty confident you're going to lease it up the rest of the way.
There's a difference between individual lease up and a market lease up.
Oh yeah.
Very different.
Very different. And so if everyone else is full, that's different. But when you've got 3 other facilities that are also in lease up,
who knows if there's demand?
How are they going to operate it? Are they going to drop the rates to $10 for a 10 by 10? Like, what are they going to do, and how is that going to affect you? It becomes a really deep dive into that portion, which is something I didn't have to think about near as much a few years ago because everyone was leasing up so quickly. And we leased up multiple facilities in under a year.
Yeah.
But that's not happening today.
No.
And so you really got to build it out and understand, how long is this going to take me? Because negative cash flow for a certain period of time will bleed someone dry, right?
Yes.
You got to either over raise or over borrow in order to create the reserves you need for the operating, right?
Which
and
development
interest reserves.
you always have to do.
Right, of course.
Like, but it's a lot of people
higher than I think it used to be.
Way
your
higher.
reserves are significantly higher than they were.
2 years ago, I saw feasibility studies that told people they were going to fill up in 8 months. This is 2 years ago, right before everything changed. And they were basing their financial performance on a 6 to 8 month fill up. I was shocked. I've never seen anything like that.
That's pretty dangerous. Even the REITs for a while were putting out pro formas. You know, they're what used to be 7-year pro forma turned into a, hey, we'll lease you up in 9 to 12 months.
Yeah.
And that was shocking. I don't know if they're probably still not doing that now.
Hope
although, you know, with their aggressive revenue management, maybe they are still expecting to lease up that much faster than the mom and pops. But that's a big piece of the puzzle now. I think I spend significantly more time in that area than anything else, because I want to know, can I actually achieve what used to be? Yeah, of course. You know, it was just a no-brainer that I was going to get there. Now it's, can I even get there?
Yeah.
And I mean, obviously we believe we'll get there in years, but will I get there next year or the year after, in time to refinance and get people, you know, their money back and whatever, if you're using other people's money. And so that becomes a much bigger piece of the puzzle. Whereas before, I feel like I was spending a lot more time in, how am I going to streamline the asset? How am I going to lower the expense load? How am I going to, but those were all minor needle moving things.
Yeah.
You know, they were adding 25 basis points, you know, or 50 basis points. Now we're talking about, if you're wrong in this one area, the property doesn't even pencil anymore. It doesn't make sense to buy it. At least not at this moment in time. And so that's taken up a significant amount of time, because you really need to know your competitors a lot better than you used to. Your competitors.
Absolutely.
And I want to be clear, like, that's not everyone in your circle market, right? In fact, I don't even like circles. I like trade, you know, I like drive times. But you can eliminate 2 or 3 of them that are, you know, if you're 100% climate controlled, like, why do you care about the dirt drive-up facility down the street?
Totally
like,
not the same product, different customers.
Or if you are, you know, one of the competitors doesn't even have a website, like, maybe somebody will buy them and install a website. Okay, it could happen. But today, they're not your competitor.
You're not getting the same customers.
So you can eliminate and get down to the 5, 6, 7, 9 competitors that are yours and study them. I mean, spend the time to know, what is their actual occupancy today? Do they have promotions? What are their gate hours? Are they providing services like 24-hour access? Because if you can do some things that set you apart, you can affect your lease up and lease up rates and how fast you can get there. I think nothing is more important right now than leasing and moving in remotely. Like, you got to be able to do that.
Absolutely.
And most people can't. They can maybe lease online, but you still got to come back the next day and be shown to your unit with the manager. If you can get all the way through to a move-in remotely, an automated move-in, now you're setting yourself apart from most of the competition, including some of the REITs. And some of these markets, you can only reserve online, even at a REIT. Like, you're still showing up, buying a lock, and being shown to your unit. And so if you can do that, I think that's probably the single most important factor to achieving at least your lease up expectations, if not outperforming them, is being able to set yourself apart in the leasing and move-in process. But that's, to me, that's a fundamental now. But a lot of people, it's not. They're still learning about some of the tech that we've been doing for years, right? I think that's probably where you need to spend your time if you're trying to figure out how to at least stay on point with your projections, is set yourself apart. Like, with it, and the tech is not near as expensive as it used to be. But set yourself apart, because when there's 5 facilities competing for the same customer, you got to find a way to have a differentiating factor.
Now, talk to me about valuations. So what are you seeing in the market today as far as valuations of what people are selling at? And has that changed? And what's your general feel?
So it's interesting. I was taking not a hiatus, but there was a period of time where I wasn't underwriting deals as daily as I am right now.
Yes.
And my understanding from talking to friends, brokers, people in the industry was that cap rates were coming up. But the last few deals I've seen actually trade are trading pretty darn aggressively. I mean, 5 caps, even slightly under a 5, like a 4.9, a 4.95 cap in this market, which I don't know who the buyer is to be doing that, but that's shocking to me because if that's really what they're trading at still on a good property, they must have some other pro forma understanding of what they're going to do with that property, because I would never pay for it at that rate. Now, there are exceptions, obviously. Your going in cap rate doesn't really matter.
Yes.
Right? Unless you're buying a stabilized asset that has no upside. Then, of course, it really matters because that's your cash flow.
But go in at a 4 in today's market, the lift you have to get
it to a 8 or a 7.5 or something that's not negative leverage is incredible. And so the fact that some of them are selling at that rate, or at least that's what the broker genuinely believes it will trade at, and you might as well not make an offer, is a little shocking. I was expecting 6.5, 6.25 to be the number, not 5.25. But it has been on the last several assets that I've seen that we missed out on. That was somebody was willing to pay a 5.25 or a 5 cap. If that's what they're willing to pay, more power to them. That's fine. But even being relatively sophisticated in how we're going to do the lease up and how we're going to do the revenue management, because I feel like we are, right? We're up there with anybody.
Absolutely.
Even with all of that, if somebody's willing to overpay for it, let them have it, right? Maybe time fixes all. Like sometimes it will, but I'm not sure we want to play that game, right? And so we want to go in with something where we have a direct business plan and path to, an exit cap rate that we're happy with and a spread that we're happy with. And some of them are just not penciling today because people are overpaying. Still.
Wow.
It's not 2021 rates, but it's pretty close in some cases, which kind of shocks me, to be honest.
Yeah. And are you finding that more in like good institutional assets?
I mean, basically we're not looking at those assets. So no, I don't think so. These are good assets. These are class A and class B plus assets in secondary and large tertiary markets. Trying to remember which one. There's a bigger city in Arkansas, Oklahoma, here in Idaho. Some of these things are trading at rates that you're just like, I can't make that work. So if somebody can, I understand, you sell it to them. So off-market deals are where it's at right now, because you really need to not let it be a bidding war if you're going to find a deal right now.
Okay. Well, it's crazy times, and you're out there, the markets are changing quickly. So analyzing and doing the fundamentals, everybody, it's obviously always important, but it's really important right now. And I think for anyone that's, a beginner or looking at getting started, I think a few very simple things that you should look at is, who am I competing with? Is there inventory, or is there anybody else coming out? Like, don't fight the market today. And if you're a beginner, don't fight the market at all. There's no reason to.
No, so partner with somebody, or do it with somebody that's
make sure nobody's coming, make sure there's no new supply coming out of the market. If you're in a market that has 95% occupancy, everybody's full, they've been full for years, and nobody is coming into that market, and you can go and verify with the city, you go check with the city, look at land that can be actually made into storage, and see if anyone submitted applications, who the owners, all that kind of stuff. Do that homework. Because if you're going that makes projections obviously way more easy. And then you're looking at the buy, right? And then it's really all about the buy. If you're in a market where you have a big range of competitors, you have lower occupancy, and you have new inventory coming up, that's hyper competitive, and you need to be ready for that. And that's where, especially on the underwriting value, it just gets more complex. So the easiest way to keep it simple is make sure the competition on the market is simple. You can do that. You're going back to really, really fundamental basics of real estate, right? If not, you're in it, you're getting into more complicated levels to make sure you can compete, and you need to be aware of that.
And it's shocking how many people weren't doing that homework the last few years. They were just taking it for granted.
At all.
So if you don't know how to do it, buy a feasibility study, or go find someone that's done a bunch of them and tell them to, hey, double check my work here, because you can make some big mistakes right now. And I think another thing that people aren't taking into consideration is really the cost of capital and how that can affect you.
Yes.
The deal may look fine from an NOI and cash flow standpoint, but if you're not underwriting a longer hold than you expected or something like that, you can end up upside down pretty quick.
Yeah.
And I don't mean the project. The project might be fine. I'm saying you as the one trying to buy it and put it together, your profit can go from this to absolutely nothing
fast
in a year.
Yes.
I mean, an extra year on your pro forma it just depends. I mean, cost of capital and how you structure it and all that. But keep that in mind, because I hear a lot of people trying to do their first syndication or their first little deal where they're using other people's money, and that's fun. I'm more power to them. I want them to do that. That's awesome. That's why we're in the business. We love it, right? But you can lose your shirt doing that if you don't know how to underwrite properly.
Absolutely.
Because time or a slight uptick in interest rates
changes,
or the pref or whatever you're doing can completely change the outlook of the property and really your profit. If you make any at all, right?
Yes, exactly.
And so I think just a warning, hey, do it right on the front end. Buy it right, do all the homework. Because you will pay for it if you don't.
Absolutely.
You will, especially right now.
Awesome. Thanks, man. Appreciate you being in here.
No worries.
Talk soon.